Ever wondered how businesses support each other financially? Have you heard about B2B loans? Today, we're going to delve into the world of business to business or B2B loans and explore how they serve as a financial lifeline for many businesses, particularly small and medium-sized enterprises and companies facing financial challenges. The concept of B2B loans might seem complex, but it's actually quite simple. In a nutshell, a B2B loan is a financial arrangement where one business borrows money from another business. This is a departure from the traditional approach where companies turn to banks or other financial institutions for loans. This unique setup offers businesses a different avenue for securing funds, one that might be more suitable to their situation. Larger companies with more financial resources and better creditworthiness often lend to smaller companies, providing them with the much-needed capital to grow, manage debts, or navigate through financial rough patches. These loans come in various shapes and sizes, depending on the lender's and borrower's agreement. They can vary in amount, duration, and interest rates. But unlike your typical bank loans, B2B loans often require a less stringent credit check, offering a glimmer of hope for businesses that might struggle with securing traditional loans. Of course, like any financial arrangement, B2B loans come with their own set of challenges. These include managing short-term repayments, the higher risk compared to bank loans, and the need for a good reputation to secure a B2B loan. But don't let these challenges deter you. When navigated wisely, B2B loans can be a game changer for many businesses. More than just a financial lifeline, they can open doors to partnerships and collaborations, fostering a supportive business ecosystem where companies help each other thrive. So, a B2B loan is a financial arrangement where businesses borrow from other businesses instead of traditional banks. It's a unique, flexible solution that could just be the financial boost your business needs. Stay tuned as we delve deeper into how B2B loans work in our next segment. Now that you understand what a B2B loan is, you might be wondering, how does it work? Well, let's delve right into it. Firstly, B2B loans can be arranged in one of two ways. The first is a direct loan, where one company lends money directly to another. This method cuts out the middleman, making the process less complicated and potentially faster. The second way is via an intermediary, like a broker or a bank. In this scenario, the intermediary facilitates the loan between two businesses. They handle the details, ensuring that both parties meet their obligations. This option may be slightly more complex, but it provides an additional layer of security and professionalism to the transaction. Now, you might be wondering, how do businesses ensure they'll get their money back? Well, that's where collateral comes in. Collateral, such as property, stock, or other assets, is often used to secure the loan. This means if the borrowing business is unable to repay the loan, the lending business has the right to claim the collateral as repayment. One defining characteristic of B2B loans is that they are often short-term. This means the borrowing business agrees to repay the loan within a short period, usually less than a year. The short-term nature of these loans can be beneficial for businesses needing quick financial assistance, but it also means the repayment schedule can be quite intense. Another important aspect to note is that B2B loans typically come with variable interest rates. These rates can fluctuate based on the creditworthiness of the businesses involved. This allows for flexibility, but it also introduces an element of unpredictability into the loan agreement. In essence, B2B loans operate on a foundation of trust and mutual understanding between businesses. The lending business trusts that the borrower will repay the loan within the agreed time frame, while the borrowing business trusts that the lender will provide the funds promptly and handle the transaction professionally. So B2B loans can be a flexible financing option, but they do require careful management due to their short-term nature and variable interest rates. It's always crucial to fully understand the terms and conditions before entering into any financial agreement. After all, knowledge is power, especially when it comes to your business's financial health. What makes B2B loans attractive to businesses? Let's discuss some advantages. Firstly, there's the advantage of a better understanding of financial situations. Businesses lending to each other may have a more comprehensive appreciation of each other's financial circumstances compared to banks. This shared understanding can foster empathy and flexibility in structuring the loan agreement. It's like two chefs discussing a recipe. They speak the same language, understand the nuances, and can better adapt to each other's needs. Secondly, B2B loans can offer potentially lower interest rates. This is because B2B loans cut out the middleman, in this case, the banks. By dealing directly with each other, businesses can negotiate terms that are more favorable for both parties. It's akin to buying straight from the manufacturer. You often get a better deal because you're bypassing the retailer. Another advantage is the less stringent credit requirements. Traditional banks are notorious for their rigorous credit checks and stringent loan approval processes. This can be a significant hurdle for businesses with less than stellar credit histories. B2B loans, on the other hand, may have more relaxed credit requirements, making it easier for these businesses to secure necessary funding. It's like applying to a club where the bouncer is your friend. You're more likely to get in. Furthermore, B2B loans can be highly customizable to the needs of the borrowing business. This flexibility can be a boon for businesses with unique or fluctuating financial needs. Think of it as a tailor-made suit. It fits you perfectly because it was made specifically for you. Lastly, B2B loans can offer speed and convenience. In business, time is money. The quicker a company can secure funding, the faster it can invest in growth opportunities. B2B loans can often be arranged more rapidly than traditional bank loans, providing businesses with the financial resources they need when they need them. It's like express delivery. You pay for the speed and convenience. These advantages make B2B loans an appealing alternative to traditional bank loans for many businesses. While B2B loans have their advantages, they also come with some challenges. Let's delve into them. Like any financial tool, B2B loans aren't a one-size-fits-all solution. They come with their own set of complexities and disadvantages that might make them less suitable for some businesses. One of the key challenges is managing short-term repayments. Unlike traditional bank loans, which often have longer terms and fixed interest rates, B2B loans tend to be short-term and based on variable interest rates. This means that businesses need to be prepared to handle repayments on a shorter timescale, which can put a strain on their cash flow. Additionally, B2B loans can carry a higher risk compared to bank loans. This is because they are often unsecured, meaning they don't require collateral. While this can make them more accessible for businesses, it also means that the lender has less security if the borrower defaults on the loan. As a result, businesses that offer B2B loans often charge higher interest rates to compensate for this risk. Another downside to B2B loans is the necessity for a good reputation. Unlike banks, which primarily assess a business's credit score and financial history, businesses lending to each other often take into account the borrower's reputation within their industry. This means that businesses with a less than stellar reputation may find it more difficult to secure a B2B loan. There's also the issue of the burden of due diligence. When dealing with B2B loans, it's usually the borrower's responsibility to thoroughly research the lender and make sure they're trustworthy. This can involve a significant amount of time and resources, which some businesses may not have. Lastly, It's worth noting that B2B loans can be less regulated than traditional bank loans. This means that businesses need to be extra careful when entering into these agreements, as there may be fewer protections in place if things go wrong. In conclusion, while B2B loans can offer flexibility and potentially lower interest rates, they come with their own set of challenges. Businesses need to be aware of these risks and carefully consider whether a B2B loan is the right choice for their situation. It's clear that while B2B loans can offer benefits, they also come with certain risks and challenges that businesses need to be aware of. We've discussed quite a bit about B2B loans. Let's summarize the main points. Firstly, we looked at what a B2B loan is. It's a type of financing arrangement where businesses lend money to each other, bypassing the traditional route of borrowing from banks. This method of lending is often favored by larger companies that have more financial resources and better creditworthiness than smaller businesses. We then delved into how B2B loans work. They can be arranged in several ways, either through a direct loan from one business to another or via an intermediary like a broker or a bank. Collateral, such as property, inventory, or other assets, are often used to secure the loan. Unlike regular loans, B2B loans are typically short-term and based on a variable interest rate, which can be adjusted according to the creditworthiness of the businesses involved. Next, we explored the advantages of B2B loans. The fact that businesses lending to each other have a better understanding of each other's financial situation than banks can lead to more flexibility in arranging the loan. Also, because there are no intermediaries, B2B loans can often offer more favorable interest rates. Lastly, the creditworthiness requirements for B2B loans are often less stringent, making it easier to obtain a loan. However, despite these advantages, there are also some disadvantages to consider. The management of short-term B2B loans can be challenging. If a payment is missed, the entire loan can become due immediately. Therefore, it's crucial to manage these loans well and communicate promptly if there are any payment issues. So, in a nutshell, B2B loans offer businesses an alternative way to obtain financing and can have advantages over traditional bank loans. However, it's essential to understand the risks and terms before entering into a B2B loan agreement. And there you have it, a comprehensive overview of B2B loans. Remember, always do your research and consider your options carefully before making any financial decisions.